On board Rajat Rajgarhia, and let's take a conversation forward. Rajat, fantastic to have you in our studio. Actually, I'm meeting you after 3 years now? More than that, in person.
Pre-COVID, yeah.
Yeah, COVID came in. We don't realize it actually.
Yeah, I got an invitation quite late.
Yeah.
Morning, everyone.
So nice to have you back. Okay, 2023 was like a great year. It may not repeat ourselves. It may not repeat itself.
Yeah.
So what should be the basic approach for 24? Capital preservation or appreciation?
Well, I think when you look at equities as an asset class, you always want appreciation.
Yes.
Right. And if you look at index as a year, for the year, last year we were up about 18-20%.
20% on the Nifty.
20% on the Nifty, right. But a very good part of those gains came in the last 2 months, right. Yeah. Especially post the election, state election results, right. So I think we can divide this market 2024 into two buckets. First is events, and we have big events, first half India election, second half US elections. The second big event is at some point the Fed changes its track. And then the third part is the size of the Indian market and the opportunity it is bringing. That is beyond a year, right? We are a $4 trillion market now growing at 10-12% per annum, right? We are in that stage of this economic phase, Nikunj, where I think it is becoming a must to raise your allocation to Indian equities, whether you are an Indian investor or whether you are a global investor, right? So I don't know how much market delivers in 2024, and I think it's going to be a rather volatile year, right? Just because of the levels where we are starting, right? But I think the trend is more. And lastly, one thing that we got taught last year, right? India, while top down is very good, the opportunities on the bottom up are fantastic. If you pick your right sectors, right stocks, right, there are many compounders, there are many large ones in the making. I think that is where the effort is mainly focused upon, which is what last year index was 20%, but I think mid-cap, broader market, many other markets were a lot larger. I don't see that pattern changing neither this year nor for the next few years to come.
That's quite interesting that you say that the mid and small caps will continue to outperform large caps, you're saying.
No, I meant that there are enough opportunities in the broader markets that you need to keep picking companies which are becoming bigger, because market caps will follow the sizes of the businesses.
Sure.
Right. So there are enough. One is Nifty, which is the most commonly spoken benchmark, right? But I think India is presenting opportunities beyond Nifty in a meaningful manner, and maybe some of them we will discuss as we move forward.
And what's the trajectory that you're penciling in when it comes to earnings growth and the kind of commentary that we'll likely see?
So again, we are seeing the divergence in the earnings growth being very significant, right? I would think that on an aggregate basis, you can look at 15-20% to be safe, because you have many offsetting factors now. If banks are doing well, IT is slowing. If autos are doing well, something else will slow. The traditional FMCG will find difficult to grow at good double digit, but the select consumption will grow. And from nowhere, industrials last year are coming out with a triple digit earnings growth trajectory in many cases. So safe to say that 15-20% earnings growth is likely, not just this year, and that's what our estimates are also pointing out, right? And when you have aggregates at 15-20%, then you have to find out buckets which grow more than that, because those exciting growth sectors are the one where you typically try to compound your money.
Okay, so I'll put a graphic out. It has the most bullish Nifty view from Jefferies and then UBS,
right,
which is 20,000, which they expect to be a down year. They don't expect 2024 to be a year of net return for the Nifty.
Right.
Whereas Jefferies is making a case of 24,000, that's about 10%. Just to get the hygiene part out on the Nifty, do you think this year could be a positive year or a negative year?
I would think this year would be a positive year for Nifty.
Okay. Do you think we will do better than the historical average? Because historical average is 12-13%.
I will be surprised if we don't do at least that.
Okay. Now for that template to play out, which is 12-13% return, triggers have to be there.
Right.
Earnings have to be there. So what to your mind could be the trigger? Because in 2023, we got abundance of triggers. The outcome of state election, the Fed pivoted, inflation peaked out, interest rates, they hit a pause button, stability came back into startup. I mean, 2023, whatever you just look up and demand and ask from God, you got much more than that. Chappar faad ke hua hai.
Yeah. So, 2023, again, as I said, got significantly masked up for that last 2-3 months of big returns that you saw.
That's for the Nifty, but in general, it was been a good year.
Yeah, it was a good year. And typically, if you look at the broader markets, right, from 2018 till 2022, the broader indices were quite range bound. It was last year when you actually saw a very big breakout in many of the broader indices, right? But coming back to Nifty again, I think if we do base case 15% earnings growth, right? And I think that the rate cycle in the global markets end of this calendar year would be lower than where we are starting today. That's again a consensus that you would see getting built on. Assuming no re-rating, at least plus minus 2-3% should be the index return. We are not starting at a valuation which is at a historical high. Right. Yes. I would say roughly 20 times. Look, again, historical averages are made of ups and downs. Right. Rarely a market stay at an average, right? Because average themselves are calculated over a 10-year period, right? If you have all the right triggers of growth, election, interest rate, earnings, and liquidity being in favor, you would not debate or argue to be at the lower end of the valuation. You would argue to be at the higher end. I don't think we are anywhere closer to the higher end. Anyways, I am also not making a valuation re-rating argument. I just think that play the earnings growth. Today you may have a large cap index which is trading at a multiple little lower than the broader market. But that is also discounting the earnings where the broader market has a bigger earnings growth than the large cap index, right? So you'll have to pick your base.
Okay. So I'm asking a very, very basic question. Markets, they peak out when there is excess euphoria, and when there is a wild play at valuations. Now, it's a judgment call what is euphoria and what is participation, right?
Yeah.
I can look at the IPO market and say, okay, wild participation. I can look at the demat account and say great participation. So let's keep the art part out, but let's look at the earnings part. So I'm just going to repeat what you've said. Important for us to get this clarity for our viewers.
Yep.
If you look at the market purely from the lens of earnings and valuations, you don't think there is a frenzy, you don't think there is a bubble, and you don't think this is the typical cycle or typical phase where the markets will peak out. Based on fundamentals, you don't think there is a bubble. Let me put it direct.
We are nowhere close to a bubble.
We are nowhere close to a bubble. I'm going to flash it.
What are the signs that would tell you there is a bubble in the making?
I would think that the bubble in the making would be that when we are forecasting 25% earnings growth and the earnings growth are 30% and people start penning a peg of 1, right? Today you have all the banks which are the largest index in this market trading at 10 to 12 price to earnings.
अभी तो बहुत दूर है. अभी तो बहुत
right.
दूर है.
You have the entire IT space, right, which is yet to participate in any meaningful manner. You have all the likes of Hindustan Unilever, which is almost at the same price what they were 2 years back, right? I would think that you have, I won't say bubble, but I would think you have seen a lot of frenzy coming into many of the sectors which for the last 7-8 years were not a part of the market at all. Especially on the industrials, defense, railways, renewables, right? But again, last 1 year return in many of them have been 2-3x, right? Last 10-year return, actually many stocks may not have crossed their 10-year highs also, right? So they are cyclicals, right? If they are into a 5-year cycle, maybe markets try to front end the return into the first year, right? That is where the liquidity angle also plays its role, right? But I think you can see rotation theory coming back into this market. And that is where investors have to tread through. That where is it that the earnings vis-a-vis valuation is offering a favorable risk return for any investor.
But will it be more of the same this year as well? Your same PSUs, defense, railways, renewables, power, EMS, manufacturing at large? Or do you think the profit pool is going to be created somewhere outside?
You just preempted that answer of profit pool, right? In this country, it is very important to identify profit pools. Whether you want to be a shark in a pond or a fish in the ocean, right? And we are going to see profit pool of many sectors moving from a pond to a semi-ocean, right? And that is where identifying some of them early, even if they have, look, for a sector, for a company to be 10x in the market cap, you will always be wondered by the first 2x or 3x, right? But don't miss that the next 3x, because that happens from a size, that happens from an allocation, right? That's why it's very important to understand how much time you spend in the market rather than thinking how do you try to time the market.
Can you just give an example to take that point forward? Examples. See, facts are hard to remember, but stories always are remembered.
Sell.
Yeah. So, at the beginning of this year, 2023, right, I would think that PSUs generally as a theme were starting to, make some buzz. You had defense, you had budget, you had government speeches, you had many indications of railway capex, defense budgets, EMS, renewables coming up, right? So you could have tried to take a stock, buy, sell 4 times in its journey of being 3x, right? If you would have bought a stock at the beginning of that conviction and rode through that entire rally, which is still not over, which is still going to continue for the next few years, right? You could have possibly captured the entire 3x, 5x, right? If you do buy, sell because sometime valuation looks high, then the story becomes better. I would think you would capture less than half of the return that your conviction would have delivered it to you. I think the same thing holds true for suppose state-owned banks, right? How many times we have seen 0.5 pe kharido or 1 time pe bech do, right? I don't think we have seen balance sheets and growth orbit better than this in the last 20 years of these banks. So why should they be constrained by a historical valuation band? Why can't they trade at 1.5, 2 times if they can deliver 16, 17% ROE for the next 3-4 years? Which means that we are still talking about these stocks that can potentially double from here after doubling last year, right? So I don't think they are anywhere close to a bubble now. I don't think if they rally another 50% this calendar year, they would still be in the bubble. Just that the stories are getting better as the growth orbit becomes better.
But within PSBs, because it is a large enough pool, how do you select? Do you stick by with the leader or do you buy a basket of some?
Look, best of them, State Bank definitely leads from the
Of
front,
course.
right? And I think that the next two you can always bet upon, right? I think this market has so many different categories of investors that the options to pick stocks within PSBs or any other sector is also relevant to the style of the investor who is looking at the names, right? Someone willing to put in $1 billion State Bank is the obvious choice. Someone willing to put 100 crore, you have another second tier, third tier. I won't say second tier, third tier, but the smaller size, right? For retail investors, you can see that the volumes in some of the even smallish PSU banks are, because ultimately all of them are benefiting from the same story. Someone is delivering better than the other. Somewhere the valuation is cheaper than the other. So your core portfolio should have the best, the largest,
Of course.
right? But the market is a combination of all kind of stocks. So I think as a theme, if you like something, you can keep trading in between some and hold core as some.
Sure. So defense, this PSBs, what else? Where is it that you find there's still value on the table?
I think as a theme, Aisha, we have been very positive on this whole travel and tourism as a space, right? This is again a sector which is just coming up in this country after COVID, right? I would say the last 18 months was the period when this sector started showing its way of leadership on the consumption side. You look at hotels, you look at aviation, you look at travel accessories, right? As the per capita consumption, travel, office travel, leisure travel, entertainment grows, right? There is a huge business opportunity for them. The other thing is, because of the COVID, the capacities have been constrained. If you guys would have traveled anywhere in this whole holiday period, I don't think.
Nightmare.
Yeah, just look
Too
at
expensive.
The crowds.
Yeah, just look at the today hosting an event in India is expensive than hosting an event
Outside India.
outside
Yeah,
India,
yeah,
right?
yeah.
And still you don't get vacancies, right? I think this is a theme here to stay. One is the earnings growth, and second is when these companies generate a lot of cash flow, the balance sheet becomes very solid. From a debt-ridden balance sheet, these companies are going to become cash rich balance sheets. So ride through this cycle, and I think over the next 2 years you are going to see many new listings, many new opportunities in this travel and tourism. That is how big sectors typically get developed, right? Today you have 4 or 5 hotels listed. I think in the next 2 years you may have dozen IPOs of the hotel companies coming up, right? So I think this is one theme besides financials, besides consumption, select consumption, besides industrials. But I think this travel tourism looks like a very powerful theme in the making for us.
And what's driving the optimism in consumption, even select consumption that you're talking about? Are not the worries of inflation, rural slowdown likely to be deterrents?
So I think the consumption basket is essentially driven by what is it that you were not spending on, which you are spending now because of the income level increase, right? What you have been consuming on a regular basis, right? You may not increase your wallet share there, but what you have not been consuming, and because of the general, like for example, where do you classify real estate, right? If you look at the amount of real estate optimism that has come in the last 2 years, it is the wealth impact which is happening partly because of the economic growth and partly because of the stock market wealth creation, right? That I categorize as some form of consumption, because this time you are seeing first time house buyers or people expanding into larger houses for self-consumption, not necessarily for investment. Yes. Secondly, if you look at, like again, I'm coming back to this travel tourism, right? Why are people traveling more, right? Why are people spending more? It is because because they can, right? And because they want to also, right? One is affordability and second is intent. Now both are being met, right? So I think you keep figuring pockets of, consumptions which are going to come up. May not be the traditional FMCG, right? But maybe many items. And I think the last thing is the whole IPO market, the primary market. If you look at the number of IPOs that have come in the last 3 years, I would say roughly about 50% plus would have been linked somewhere to consumption. So this whole options being available to invest also is drawing up a lot of money into these sectors.
You represent the institutional business, and institutional investors follow what could be called as an ESG template. 2021-22, their template said anything which is non-environment, anything which has got nothing to do with governance, anything when there is a lack of corporate social responsibility, avoid that sector, whether it was tobacco or utilities. जहाँ से धुआं निकलता है उसको invest मत करो. Now ITC has gone up, NTPC has gone up. Why is there change? I mean, this is a big change from an institutional perspective.
So I think so Nikunj, if you take like a 10-year view, right? I think ESG will only become stronger as a theme. In between that, you see variations of people moving to extreme, right? ITC got traded down, maybe partly because of ESG, but largely because the earnings growth was subpar, right? I think whether it be institutional investor or an individual investor, everyone wants to chase growth. Yes. Right. And whenever growth comes, even if for 10 years you may not be bucketing that stock in your portfolio, right, you always have some short-term opportunities that you want to encash upon, right? The ESG template itself is going to get more stronger, and people are going to bucket them into completely red line and maybe some bit of orange or amber, right? I think right now we are ourselves developing the whole ESG template as a market. But right now, growth is what is overriding. If you see that because of underinvestment due to ESG, opportunities for those sectors in the immediate 2-3 years becomes pretty good. No one will want to miss out at least on that. Unless your fund are very strict ESG compliant. I don't think that the very ESG compliant funds, right, would venture out of their own mandate. But many other funds, I think, they can always make a 40-60, 60-40 effort to see how they can capture the short-term returns.
As an institutional broker, you need to have an edge. I'm sure when you talk to your clients, they would say, if you talk about India is a growth country, financials are a play on economic growth, consumptions will grow. Those are like consensus views. But when you are speaking to your clients, what is the differentiating view where you are differing from what your peers are saying, or you would say that, look, this is a new idea which we've stumbled upon? I'm just going to enumerate that point for the benefit of our viewers. You came out with a great report on the footwear industry, for example. That was a great report. Nobody was ready with that report when you came out with that report. So for 2024 and beyond, what would you say would be your differentiated idea where you think, hey, it's new or it is different from what the consensus is?
Well, I think, Nikunj, while we always try to capture newer opportunities, and we will do, I can assure you and all the viewers, because that's what the focus of the whole team is, right? I think a lot of the time, big money is made out in your existing coverage itself. And I'll give you a prime example. Last year, if banks stole the limelight, and if you just categorize the return of banks across the listed universe, you have the larger banks which were actually negative to just sub 10% return.
Yeah.
And you have several of the stocks which delivered 30 to 70% return. Within the sectors itself, if you can identify which are the ones which are going to do well over the other, I think a lot of the differentiation can be made. Look at autos, look at IT. IT, which was painted as a sector with a very underperforming year, you had the mid-cap IT which delivered 40 to 50% return versus some of the large caps.
Yeah.
So I think get the theme right, but more important than the theme, get the stocks right. Because even within the same theme, every stock doesn't deliver the same return. So I think that is where we try to build some edge, and plus keep retesting that hypothesis that at every price, every valuation, is the hypothesis still being good, or there is more upside or something which is getting fully factored in, right? Plus, as I said, there are few multi-year themes that you need to be. We did a big report on EMS mid next year. Yes. We did a report on QSR. I think that's a multi-year opportunity in this country, right? So some of these themes, they may not perform well for 6-9 months, but these are multi-year themes. And that's why I said the time you spent in the market is more important than trying to time the market.
You know, we've spent 25 minutes and we've spent some fantastic time in
But
discussing
we've not got
markets.
one stock idea.
So let's wrap it up. So Rajat bhai, every year, you know, you have some outliers in the Nifty. For example, last year it was Tata Motors and NTPC. Before that, to a large extent, you know, you had large movement which came, let's say, in ITC. Before that, it was SBI. So if you have to, let's say, make a probability, where the probability of beating the Nifty, which is 15-16% according to you, is high, which are the three stocks which could be the standout names for 2024?
So just within the Nifty, I would think you can make one pick between an SBI or an ICICI. Okay. Because for any stock to deliver a big return,
SBI
the starting
and ICICI,
valuation...
I didn't hear HDFC Bank.
So, you know, then I would have to narrate all the banks listed in the Nifty, right? Okay. So I'm just picking the top two within our universe, right? I think second is M&M as a company looks pretty good for us. If you look
even
at
these levels, because it's had a phenomenal run since COVID.
So, you know, when you look at the entire sum of the parts story, you may have a scenario where all the pieces are now beginning to look good for them for the next 2 years, right? So I would think that M&M is again another thing which can look pretty good. I would think that if we are so positive on industrials and capex, then the one allocation stock in this country is just L&T, right? And that will continue to compound because the size of the opportunity they will target every year will keep growing high. So I think these three, at least right now.
And you said select consumption, so anything there?
So in the consumption, I can give you basket. You can look at QSR, you can look at jewelry, you can look at travel and tourism, right? You can pick up stocks that our analysts portray. But I think these three, and I can tell you there are more spaces which are going to come up in the consumption basket is going to be bigger than the financial basket, you know, when you will club all of them put together in the next 18-24 months, right? You know, just a year back, Titan used to be one jewelry company that used to be spoken about. I think in another 12 to 18 months, you will have dozens of jewelry companies being listed. So Titan would still remain
the leader,
the leader, but you will have many other alternatives to invest in, right? So this market is going to offer lot more opportunities, and that's why we say broader market will keep offering you more opportunities, while in the index you have to be selective.
You wouldn't give us 3 mid-cap names, would you?
Ayesha, every day we are releasing a top idea from our desk on the mid-cap.
Yes.
Today we released Shobha, day before yesterday we released Lemon Tree, then we released Dalmia Bharat. And the intent is that at the beginning of the year, we are showcasing our top mid-cap ideas to our investors. So that's why I'm sure,
You captured it, yes.
you guys are, and please do market those ideas of ours also.
Yes, of course, they are your
But
proprietary
the
data.
viewers like to hear it from you.
Well, all these buckets that I mentioned, right? If you look at QSR, whether you look at a Devyani or a Burger King, you look at jewelry, you look at travel and tourism, Lemon Tree. Indian hotels is kind of becoming an allocation stock in my view, right? So I think, there are host of, and we would be releasing our preview strategy anytime in the next 2 days,
Yes.
right? Once Gautam is here, he's going to showcase all our portfolio picks, which are going to be very interesting.
Fantastic. And I am sending you an email right away so that we don't say that we were not invited. Let's block our next interview very soon. This time, not 3 months, but hopefully 3 months. Not 3 years, hopefully 3 months.
Anytime.
Thank you very
Thank
much.
A
you.
month.
Thanks.
Let's have him for the budget.
We shall reach out to you. Thank you
Thank
very
you guys.
much.
Have a good day.
Nitya Balasubramanian.